Good morning, everyone. Thank you so much for your time today. My name is Lester Davids, and I'm a part of the Unum Capital Trading Desk, where I provide multi asset class research in support of the private client traders and portfolio managers. Today, I'll be having a look at a couple of charts, but before I get into that, I'd like to take a brief look at our current economic situation, our global economic situation, and how that has led us to our current financial market condition. First up, I've got a chart of the US and China GDP contribution to the global economy. In 2018, these two countries have contributed 31 trillion to GDP, and that's up from 19 trillion in 2008. So any friction between these two countries has a major impact on the global economy as well as sentiment. As you may have heard, we've heard talks about trade wars as well as tariffs being imposed by each country on the other, and this has had a major impact on the global economic sentiment and has really impacted on the equity bull market which we've experienced over the last number of years. In the US, however, we have seen since 2010 global or GDP growth being positive, ranging from 1.5% all the way up to 3.5%. And this has really helped sentiment over the long term. We also see in the US consumer sentiment being at multi-year highs. We see over the last number of years, over the last 5 decades, we've seen consumer sentiment only reaching the 100 level only around 4 to 5 occasions. And this is quite important because the US consumer is around 70% of US GDP. So any uptick in consumer sentiment is positive, any downtick is negative. Just to have a look at the United States, just a quick again, we see GDP up, we see business confidence up, consumer confidence up, unemployment at a multi-year low, tax rates down, and we have inflation rising. So all of these factors, who do we have to thank for that? Well, I'd say that we have the central bankers to thank for that. We've got the US Fed, which was Ben Bernanke, who was instrumental during the financial crisis. We have Janet Yellen, who was instrumental in the last number of years. We currently have Jerome Powell, and at the ECB we've got Mario Draghi, as well as Haruhiko Kuroda from the Bank of Japan. So what they've basically done is they've slashed the cost of money, and they've given us a decade of money basically. So we've seen since 2008 up till 2010, we've seen record low interest rates. And if you have a look at the historical chart, you'll see that pre-1980, we've come back from about 20% interest rates being slashed all the way down. So there's been a big downward trend over the last 30 years, over the last 35 years in interest rates. We are now seeing that starting to lift, and that is a major concern for equity markets with inflation starting to creep back in. I've also got a chart of Brent crude oil. Brent crude oil takes us back to 2003, late 2003, 2004, where we've seen a big run up in the price. And since then, we've seen prices fall back. And over the last 2 years, we've seen prices tick higher again as global growth has increased, as supply has been reduced. So this has been a major contributing factor as far as inflation is concerned. So as you can see, we've had US inflation on the rise, ticking over the last 2.5 years, ticking above the Fed's target band. And that has really spurred confidence or inspired confidence for the Fed to be able to start gradually raising rates. Beginning of the year, we've also seen the US dollar rise. It has been negative sentiment over the last number of years for the US dollar. However, we've seen the US dollar starting to rise as the outlook for interest rates has started to improve in the US. From a technical perspective, however, I do see a bit of a topping pattern, a bit of a head and shoulders pattern, which could potentially signal a softer US dollar over the medium term. Year to date, we've also seen emerging market currencies come under massive pressure as the US dollar has gotten stronger and money has flowed into the United States. As you know, the South African rand has been under massive pressure. That has been domestic factors as well as global factors that has impacted our local currency. And for any readers that have been following us, you'll notice at the beginning of the year we had a trade idea where we basically asked the question, in terms of emerging markets, is the party over? We highlighted this in January, and since then we've seen emerging markets come under massive pressure, which has been a big theme for 2018. So anybody who followed the trade, you've basically made a bit of money and you've benefited from the fall in emerging markets. So money to be made on the upside as well as on the downside, as is the case with the emerging market, the prior emerging market trading idea. So just going back to the US dollar, in the short term, a bit of a sideways or even downward movement, which may potentially benefit or bring emerging markets back into favor and create another short-term opportunity on the upside for emerging markets. If we have a look at the long-term chart of the US dollar, we can see that in 2015 we had this big break of a 30-year downward trend. So we've had a breakout in 2015, and since then we've seen markets consolidate in terms of the US dollar. We've had a bit of a pullback, and over the longer term, there is potential for the market for the US dollar to actually move higher from current levels. Although, like I said, we could see a pullback in the shorter term. Looking at the US dollar versus the South African rand, we've seen our price breaking out of a long-term channel, signaling long-term weakness. We have, however, seen the price start to pull back, and this is where a retest of the top of the channel comes into play. So I definitely wouldn't be surprised seeing the the South African rand testing the 13 rand level against the dollar again. So short term, some strength for the rand, but over the ultra long term, the technical pattern or the technical setup, so it shows us that there actually could be a bit of weakness going forward as the US dollar also appreciates. One of the big concerns in the US has been the US treasuries. We've seen rates rise to above 3%, and this has caused major negative sentiment in global equity markets. So the question is, are we going to see 3.5% or are we going to see 2.5% again? From a technical perspective, it seems that 3% or 3.15% seems to be a level where buyers have definitely started to become interested, and this could actually bring us back to lower rates, which may bring a relief to equity markets, including emerging markets. However, 350 possibly means more downside for equity markets, and that'll totally depend on what the Federal Reserve's path is and outlook is for raising interest rates.